Hello, and welcome to the Complete Day Trading course by your friends at Wealthy Education. In this course, you'll learn exactly how to make daily returns by day trading whatever you want, including stocks, options, forex, or cryptocurrencies. So if you're looking to become a highly profitable day trader and make a good living or extra income online by trading stocks, options, forex, or cryptocurrencies, this course is for you. Okay. Let's take a look at what you're going to learn from this course. Jumping into day trading without proper training is a good way to set yourself up to fail. Day trading requires extensive trading skills and experience, and the most important part of it is technical analysis. So that's why in this course, we'll provide you with a strong technical analysis foundation. You'll learn exactly how to day trade profitably using technical analysis. You'll learn how to use technical indicators, oscillators, and chart patterns to identify market trends and directions so you can easily profit from your trades. You'll also learn how to avoid blowing up your account by following our risk management tips and strategies. We'll walk you through how to use over 20 technical indicators and chart patterns. We'll provide you with all recognition criteria and trading strategies so you can easily apply everything right off the bat. And as always, you'll learn with a lot of real-world examples. So, I'd like to invite you to join us in this class and learn how to become a highly profitable day trader in a short period of time. So let's get started. Take this course now, and I'll see you inside the course.
Hello, and welcome to the first video of Module 1, Day Trading Preparation in the Complete Day Trading course by Wealthy Education. This video I'm taking a look at TradingView for chart analysis and paper trading. So the first couple of things you should learn is trend lines and how to draw them. So you can go right here on this submenu and you can see that I clicked on the arrow and there's several different types that you can get. But a typical trend line is really all we're looking for. You just click, you hold, you drag, you click again, and there's your trend line. It's drawn quite nicely on the chart. You can drag it around. You can obviously move it in whatever direction you need. You can right click and delete, or you can just highlight it like so. That's highlighted because of the bubbles, and then hit delete, it'll go away. So you can also do channels. Click on this little arrow. You go to parallel channel. Parallel channel works very similar. You can drag and click again so that trend line is drawn, and then you drag up or down depending on which way you need it drawn. And you can see that, once I click out of all of that, draws a nice parallel channel that you can see that's very nicely drawn on the chart. It's one of my favorite actual features of TradingView because it is so cleanly designed. So how do we use trend lines? Well, trend lines are pretty straightforward. And, granted, this is a daily chart on US Steel, but it's going to be the same no matter what. But you notice how the buyers continue to come in. So in a situation like that, you just simply buy every time it gets tested. There are a couple of parameters that you want to see. You want to see a trend line tested at least 3 times, which it would have been by here on the daily chart. So that would have been an area of interest. That would have been an area of interest. That, and so on. Now you can see that we have clearly gapped lower and broken that trend line. So that shows that the trend may be changing from a longer term perspective. Now, day traders, of course, won't necessarily be using the, daily chart. It does give you an idea of where the market may be going longer term. And here on the 15-minute chart, you can draw a downtrending line, and you can see that we did pierce above it a little bit, but clearly we're in a downtrend. We sell off every time that we get close to it. And this little bit here brings up an interesting point. There are different ways to avoid being faked out, and that could have been a fake out for you. Some people say it needs to break 3% in value above there. Some people say it needs to close above there on an hourly candle or a 4-hour candle. There are a multitude of ways to kind of not worry about being false breakouts, or there are some who are just typically, very stringent about it. So for those people, you would have formed a trend line there, you would have sold there, you would have probably sold there on that gap, and then the fall, you rally up here, you would have sold, and you would have got knocked out. So that would have been a loss after a couple of wins, and that's essentially what you're counting on with a trend line. You're counting on that eventually you will get stopped out. But in the meantime, what you're hoping is you get multiple buying opportunities. So, maybe it's like, on a really good one, it might be 6-1. You get 6 wins, 1 loss. Well, you're making money and that's your goal. Channel trading is a little bit different in the sense that, for myself, I think it's a little riskier because you're playing both, up and down trend. And because of that, you're also playing both, with the longer term trend and against the longer term trend. So as I draw this one on Sprint, you can make an argument for this being a decent channel. And what you would do is you would look to sell as you got to the top of it, look to buy at the bottom. But ultimately, channel trading is a little dicey. It tends to work better on the higher time frames. In a situation like this, there's another way you could look at this. You could say, okay, well, we have this area here that's been broken above. So obviously we've gotten pretty strong. You could make an argument for a trend line there. Well, you could just buy there. It's a little safer to do it. Plus, you want to see some volume rising. But those are a couple of ways of looking at it. Channel trading is not impossible to make money off of, but the very fact that it involves counter trend trading does make it a little riskier. So that's something that you should be aware of. It doesn't mean it can't be done. It just means that there is that higher amount of risk. You'll notice that the channel has a dashed line in the middle. That's essentially fair value. That's midpoint. So that's a way to look at it as well. But again, channel trading is possible and it can be good. But you have to realize that, like in this case, when you're selling against that type of move, you are going counter trend. And that will be especially true if you were to do it, on a higher time frame, like a daily chart. You can really get into a little bit of trouble eventually. So keep that in mind. Not impossible. You want to line up the right candlestick pattern, that type of thing with any trend line, either a single trend line or a parallel, which is essentially, 2 trend lines parallel to each other. And look for the right price action at those levels. Remember, trend lines in support resistance, that type of thing, is only going to be a guide stick as to where you go. So I also mentioned that you can do paper trading, and that's pretty simple to do. You just go down to the bottom, and there's a panel here that if you click on paper trading or strategy tester or whatever, the editors, you can do, like coding, if you know that. You can write notes. But the paper trading pulls up, and it starts out with an account of $10,000. Now, if you don't have a paper trading account, there's a tab here, and it'll ask you, what broker do you wish to use? And you're looking for paper trading by TradeView. It's a practice account. There's no cost involved. And then you just simply go up here, and you can right click, and you can click trade, and you can do a sell limit, sell stop, and these are orders that we'll talk about in a future video. Or you can create new orders. Now, this is based upon where my cursor is. The higher level here, obviously 778. And if I want to trade at 572, it's easier just to click create a new order, because that way you don't have to line up there. And you can choose your type of order, the price, that type of thing. Now the market's closed, so the prices aren't moving. You can put a stop loss, take profit, quantity, etc., and sell, buy. Pretty straightforward. And then this will simply keep track of your trades, execute the orders as needed, and it shows you whether or not your strategy works. Excellent way to practice day trading. And to get rid of this panel, you just click the hide button, and it goes right back to the normal chart. Hello and welcome back to the complete day trading course by Wealthy Education. This is a video on how to choose the best chart timeframes for day trading. So in front of you, I have Pandora on the daily time frame. And the reason I do that is because I want to press upon you, and I'll even go to the weekly to show my point. I want to press upon you the fact that we are most certainly in a downtrend on the weekly chart. So what happens, unfortunately, is far too many day traders will look at this chart only, and a 15. Now, in this case, it happens to line up quite nicely with the overall trend. But unfortunately, some of you out there may have chosen to look at Pandora during this time and go, okay, well, it's starting to rally quite nicely. That's a good sign, right? Well, you can see what's happened. And that brings me to my point. Top-down trading, without a doubt, is probably one of the best things you can do to protect your account. So clearly, let's see, over the last 5 years, Pandora has fallen from $40 to $8. Now, does that seem like a stock you want to buy? The answer, of course, is no. Now, unfortunately, a lot of people look at that and go, well, it's really cheap. How much further can it fall? Well, the answer is it can fall to zero, and some stocks do. Plus, you also have to keep in mind that there's a certain threshold that a lot of funds won't touch, and some of them are $10. So there are large funds out there that won't be bothered with this stock. Beyond that, companies go bust all the time, and therefore you can't buy something just because it looks cheap. There has to be a lot more to it than that. So with the time frame you're looking at, you really want to look at the weekly first, and then the daily. And you can see that we've had a bit of a pop on the daily, and it looked pretty good there for a minute. But it looks like it's starting to roll over. A little bit of support just below, you can see previously. So the question then becomes, is this previous resistance now going to act as support? It very well could. And then you want to zoom down to, maybe the hourly chart. And you can see that the hourly chart shows you much the same thing. So what does this tell you? Number one, this tells you that even though the longer-term trend is very negative, this is a market that is going to need to make a decision here. Clearly right here, there seems to be an area of support and resistance. As the trend is most certainly negative longer term, I'm much more comfortable shorting underneath that area. If it bounces, that's fine. It might be a short-term play. But if there's only one thing that I can press upon you in this course, it's going to be what I'm about to tell you right now, that I think is by far the biggest decision factor, that and money management, as to whether or not you'll be successful. If this market bounces here, it very well could go to $10 again, and I'm the first to admit that. However, with the way this stock has behaved for 5 years, I'm much more comfortable shorting it because clearly something's very wrong. So let's go ahead and switch to Apple. You can see that on the weekly chart, shouldn't be much of a surprise. It's been in a nice uptrend. There have been times where it's fallen, and you could have made money from the short side. But you have to ask yourself the most obvious question. What's been easier to do, buy or sell Apple for the last 10 years? Well, obviously, it's been very easy to buy it. Some people have made an absolute ton of money, not only buying it, but holding it. But as a day trader, you need to recognize that this is an uptrend. You need to recognize that the weekly candlesticks are starting to show support here based upon these hammers, right at about, say, 215 or so. So you take note of that. You can, for example, even put a horizontal line right in that neighborhood. And then you take that and you go to the daily, and you can see that the daily clearly is trying to respect that area as well. And then you can go to the hourly, for example. And then you get an even better close-up look. There's a nice hammer there from that level. It's bounced a couple times since then. It's gapped higher. That's a good sign as well. So again, what's going to be easier? Well, buying is going to be easier. So for a time frame, you can use the 15-minute chart or even the 5-minute chart. But you want to align your signal on this short-term chart with the longer-term analysis. In this case, the longer-term analysis is a buy signal. Now, looking at this, there is an obvious area of resistance here at 220. There's an obvious and very negative candle right here. This is a 5-minute chart. So could we drop down to 217.50 again? Yes, we most certainly could. However, there's a lot of demand there. And you have to recognize that as shown from here. There were a lot of buying pressure here. The buyers step back in at that level. And now we may be offering value. It's not to say that I can guarantee that buying here is going to make you money. There's no way to guarantee that. But the odds are there's going to be enough demand down there. Certainly favors a bounce over a breakdown. So the answer to the question how to choose the best chart time frame for day trading is simple. You start high and you start to drill down. You want to see which way the market's been treating this stock for the last year, 2 years, whatever, the last several days, last several hours. You mark the most important parts on the chart and you attack it when it gets to that area. Otherwise, you're doing a lot of gambling. And you can see that clearly, even if we break through this gap, there's a ton of support underneath. So unfortunately, a lot of short-term traders will see this gap being broken and think, okay, well, it's going to get filled, so I need to short it. When the reality is, it's just simply easier to wait till down here and buy. Remember, day trading is going to be about precision. And the only way you're going to get precise exits and entries is if you look at the big picture first. Hello and welcome back to the Complete Day Trading course by Wealthy Education. In this video, I'm taking a look at order trading types. So I mentioned earlier there was a paper trading account on TradingView that you can use to place orders. But there are a certain handful of orders that you use on a daily basis. So in this video, we'll take a look at them and why you may use them and why you may not. So you can right click on the chart and go to create new order. And there's a market order comes up. Now the market's closed, so the gap shouldn't be $5.31 on Apple, but it is because the markets are closed. We don't actually have any trading going on. But a market order would be simply buy or sell. So I want to sell, I want to buy. So say I wanted to buy Apple. A market order would put me in the market at the best available price for however many shares I'm willing to buy. Go down to the quantity. You can set your stop loss and your take profit right away. And just put in and say, I want to buy it right here at this price or the best price available. And it will fill me at the best price. It might be $219.31, it might be $219.30, $219.29, $219.33, whatever. It'll be somewhere in that range. Typically the spread isn't like this, as I'm sure you're aware of. But that is the easiest way. A market is just simply get me in the market at the best price available. The problem, of course, is you do get some slippage, so it's not the preferable way to enter. So there are limit orders as well. And a buy limit order, which would be buying at a price, limit goes underneath the current price. So let's say that I'm willing to buy this stock, but I'm only willing to buy it at $216. And again, this is a very wide spread. It's not typical. So what happens is that it puts it out there, and if somebody's willing to sell my 100 shares to me at 216, my order will get filled, and then we're off to the races. You can also use this as a way to get out of a profitable short trade underneath the ask. So say you were short from 220 or 250 or whatever. If somebody's willing to pay you 216, you're willing to get rid of the trade. Now, the problem with limit orders is if your particular price does not get hit, if there's nobody willing to in this case, sell to you, it'll just skip right past you. It says, I'm only willing to pay this amount. Now, a sell limit order is the exact same thing, but in opposite. So it's above the current bid. So in this case, I want to sell at 216. Right now, they're only bidding at 214, so they need to drive price up to me, and I will sell them 100 shares. It's also a way to perhaps take profit on the way up. But if it blows past 216, it might be 216 and a quarter before you realize that. And, in this case, you make more profit. That's not a bad thing, but it's just to let you know that your order may or may not get filled. But it is a way to get out at that specific price. So that is a sell limit order. Now, there's also the buy stop order. So a buy stop just means that it's a bid that's placed above the current price. So I'll just do 220. And it's only filled at or above that price. Now, why would you want to buy, say, at 220, just say you get some slippage, it's 5 cents. Well, the reason is that perhaps you are short and you are looking to protect profits or just protect against major losses. So once it hits this price, it'll get you out of the market at the best available price. Now, it may slip a point or two. You just don't know. But it's a way of protecting your account, if you would. It's basically a stop loss on short position is a good way to think of that. And it is a market order. So again, it doesn't guarantee you'll get filled that price. But if you were to do a buy limit order instead, if it skips your price, you're still in the market. And that could be a lot of trouble. If it's a fast moving market, it skips the nickel and it goes straight to 6. You could be up at 225 and still short this position. So that's why you want to use a stop as a way to protect your account. The last thing you want is to have it pile up on you. Now, there's also the sell stop order, as you can imagine. And it is the same thing. If you're long of the market and you want to protect, say at $200, you want to get out, it's a market order to protect your long position. Doesn't mean you'll get out at 200. You might get out at 199.99. Typically with a liquid stock like Apple in this case, you typically get your fill price or maybe off by a penny, but it's just simply a way to protect yourself from getting into major trouble. These are mandatory. You absolutely must use these types of stop loss orders because if you don't, you can get hurt. Now, a stop loss here, like if you just go in with, just say the market, the stop loss acts as a stop order. So does the take profit. If you wonder what those are the same thing. So those are stop orders. Limit orders, the easiest way to remember this is market orders is get me into the market. It doesn't matter to me, however. Limits are I'm willing to pay or sell at this exact price only or better. And a stop loss or stop orders are stop losses. So essentially this is if price reaches this level, I want out as quickly as possible. Hello and welcome back to the Complete Day Trading course by Wealthy Education. In this video, I'm going to have a few words about short selling and short squeezes. First of all, I have to explain what short and long are. Short and long are ways of identifying a position. Long is probably what you most understand. That's just simply owning something. In this case, I've got an Apple daily chart in front of you. Buy it anywhere here. As long as you're in the market, you're still long Apple. Maybe 100 shares, 1,000 shares, 1 share. It doesn't really matter. Now, to be short something is to try to profit from the value falling. And in the stock market, you go out, you borrow shares from a broker somewhere, and then you turn around and sell them to somebody else. The idea is you can buy them back for less. So say you sell them for $500 and you turn around and you buy them back after it's fallen in price to $400, you get to pocket the $100. Now, obviously, if the price rises, it goes against you and you have to buy it back at a higher price. There's an entire situation behind borrowing shares. Not all shares are easily borrowed. So there's that. But if you're sticking with liquid stocks, which you should be as a day trader, it's not too hard to find shares to short. Most of the time, your broker will carry a certain amount of them. So long is your owning, short is your selling. So there is such thing as a short squeeze, and a short squeeze is quite often seen around earnings. It doesn't have to be, but a lot of times it is, or some type of news. And what happens is you get far too many people negative of a stock. They've been shorting it for some time. Some good news comes out, turns everything around, and the stock takes off. It's not necessarily the easiest thing in the world to identify, but it's essentially what it is simply a sharp move higher. So it really is kind of neither here nor there, but you'll notice earnings came out right here, and then the market just shot straight up for Apple. Earnings here shot straight up. So anybody who's short of the market right there is trying to cover, meaning buy. So let's just say you shorted here. Market's going your way for a while. Earnings come out or news, some type of catalyst, and the market starts doing this. Well, your losses are piling up because if you think about it, a short seller could, in theory, lose an infinite amount of money because price could go, I mean, it's not going to, but it could go all the way to infinity. There's nothing stopping Apple from going to $1,000 a share. And if you shorted at 100, that's a major problem. Buyers, on the other hand, I mean, the worst it can do is go to zero. And then, you just don't have any money, but it doesn't, it does stop. It has a built-in stop loss at zero. It can't go below there. So at this point, it's a short squeeze. Short sellers have to turn around and start buying shares back. And what will happen is they'll put more buyers in the market and it will drive price up rapidly. Kind of like what you're seeing here. What's the difference between a surge in volume to the upside and a short squeeze? Well, the quick answer is nothing. It's just there's a catalyst, and it's an easily identifiable catalyst in a short squeeze where you have short sellers jumping ship because of overly good news. You see this more during, again, announcements, during earnings, that type of thing, because there's a reason for that type of move. Otherwise, it can be a little bit hard to identify the exact reason, but at the end of the day, it's the exact same thing. Any massive move higher, even if it's not technically a short squeeze, it has the same effect on the charts. Hello and welcome back to the Complete Day Trading course by Wealthy Education. In this video, I'm going to talk about how to avoid blowing up your account. So, one of the biggest problems that I see consistently from traders is they get into the market and they have dreams of being rich. And yes, we do this for money. But we have to keep everything in perspective. So, and a lot of this comes down to marketing. You see marketing materials, they'll say, hey, I can teach you to day trade and I can take that $1,000 and you'll have $100,000 in no time, and they show pictures of people flying on corporate jets and all of this other stuff. Well, that's not the reality of trading. The reality of trading is it's a slow and steady process. You're going to have days where you lose money, not trades, but days, weeks where you lose money. But at the end, what you're trying to do is make more than you lose. And then over time, everything compounds and it becomes a serious business. And that's the biggest problem that I see with people trading. So let's take a stock here and let's just say we're trading US Steel. That's our favorite stock. And it is trading at $10 and it makes a move to $9.90. We bought it. It's gone against us. Well, one stock, and I'm not including transaction fees for simplicity here. If we owned one stock, it cost us 10 cents. Well, what happens if we own 100? Now we're down $10. How about 1,000? Well, now we're down $100, and so on. And unfortunately, what happens is a lot of amateur and beginning traders look at this and go, well, look, if it went up a dime at 1,000 shares, I could be up $100. And that's true. But you're going to have the losses, and the losses, for some unknown reason, always seem to come when you're the greediest. So let's take this $100 loss, and we're now down to $900 from the original 1,000. Well, what was a 10% loss now is going to take basically an 11% gain to turn things around, because 10% of 900 is $90. So you're going to need to gain 11%. And that's where risk and money management skills are so crucial. You don't want to lever up the trade. You want to be as cautious as possible. As a professional trader, your number one responsibility is to protect your trading capital. That means some days you just don't trade. But even if you do and you lose, you take small, manageable losses. A lot of professional traders will risk 1% of their total account per trade. And if your account isn't big enough to do a 1% trade and have it meaningful, then you probably don't have a big enough account. That's just the reality. Some traders will double up on a very good setup. So, for example, this is a nice ascending triangle and an uptrend. We came back, tested that. They may risk 2%. They put their stop loss wherever they need to. They measure at 2%. And that's called going in a little heavier when the setup's a little better. So that's one way you can supercharge your losses, because even then, a 2% loss isn't catastrophic. A 2% loss on a $1,000 account is $20. It's not the end of the world. I mean, you don't want to look at every trade like that, obviously, but it is manageable. Trading psychology is crucial. I cannot stress this enough. You must simply be willing to enjoy the process, because if you are just looking to make money, you don't need to trade it. You could have other people do it for you, and you don't even have to worry about it. If you enjoy the process like I do, then you learn to enjoy the entire process. Even when you're losing money, you enjoy the challenge of it. The money almost becomes secondary, because if you hang on to the profit and loss too tightly with your mental capital, and that is something that you will spend way too much of your mental capital, this can become a very exhausting game. You can get something that's called a margin call if you have things levered up too much. So, for example, whatever your broker offers, say it's 5-to-1 or something. So your $1,000 could buy $5,000 worth of stock. Well, there comes a certain point, and it's going to be a little bit different with where your locations and stuff, but there's some certain point where that margin that you put up the $1,000 isn't enough to protect the position, and they will liquidate you, and it'll blow up your account. And that is the absolute worst feeling. Many traders have done that and then have come back to be successful. It's not the end of the world, but it is the end of your live trading for a while. This is why you paper trade. This is why you use low margin. This is why you use low risk strategies in the form of money management, risking 1, 2, 3%, whatever it is. This is why you do that, because markets can move in very erratic manners based upon things that there's just no way to see. I mean, look at how loved Apple had been 2013, 2015. And then, I mean, that's a pretty big drop there from 135 to 90, If you're long of this, heavily levered, meaning that you're borrowing shares to buy with your $1,000, it's not going to take long before those losses are worth more than your account, and then you're done. There is no more trading. If you build up over time, you can eventually get this to be a sustainable and large account. If you already have a large account, then you definitely need to protect your money anyway, because volatility comes and goes, and we have events where you can get stopped out all of a sudden for no apparent reason. But if you're down 1% or 2, It's not the end of the world. You recognize that you were wrong in your analysis, and maybe it's time to reevaluate the entire market, be it Apple or, it could be commodities, it could be Forex. It doesn't really matter what it is. It applies to all markets. You do not want a revenge trade. That's the quickest way to lose money. Because what will happen is you go long here, and then the market goes against you. You end up getting stopped out. You get angry, so you short it, and then it goes against you again. Happens quite frequently, and it's a great way to pile up the losses from 1% or 2% to all of a sudden 10% by the end of the day. And then you're spending several days trying to get that back. There are different ways to handle this, but I know some traders that once they have a loss, they make it a I can't trade for an hour rule, and they just won't trade for an hour regardless of what they see. This is about your own psychology, so it's going to be a little bit personal for each of you, but just understand the dangers of over trading. Looking for the right setup can get you all the profits you need for the day in one trade. You don't need to trade 14 trades. If you're really wanting to hyper trade, then go to the paper trading account. That will save you a ton of money. Maybe you'll learn something new there, but that's not a bad thing either. But by all means, do not risk too much on any one particular trade. That's it for Module 1. In the next video, we'll start Module 2.